is gone. I gotta get it on and find my strength. Cause the road I chose, yeah, it's always full. Those highway nights make me feel so safe. I chased the lightning, I got soaked in the rain. Danced with my demons till I couldn't see straight.
Welcome to Innovative Strategies with Bill Hasse. Innovative Strategies is a show designed to help people with their business and personal financial literacy, but not the way you've known. This is not your grandpa's financial literacy, as Bill uses his 30 plus years in the financial industry to stretch your financial box from, about a 33,236 foot view of things. Bill and his guests have helped hundreds of clients achieve and surpass their financial goals. If you've got questions, you can email Bill at Bill Hasse, that's Bill at BillHaase.com, or reach out to him right here at 216thenet at gmail.com. Just put Innovative Strategies in that subject line. Of course, today we are making the trade, managing the risk. Good morning, Bill.
Good morning, Ken. How you doing?
I am healthy. More than you can say.
That makes one of us. Yeah, I forgot how inconvenient a cold can actually be. It's been so long, but we'll muddle through. And we have a great show today. Great guest, someone who has followed a similar path to mine over his career. And I'm really excited to have him on and have a great conversation with him. Bill Ulivari, he started back at the SIBO back in 1982. I started there actually in 1986.
Nice.
I lasted about a year and a half and then moved up into an office and then over to the Burke and Teal Exchange, where Bill actually eventually did wind up there as well. He's an exciting guy. He's been on a number of different shows, Business First with Angela Miles, the Hannah and Fred show. He's done Catholic Talk on the Relevant Radio. Been on the WBBM Noon Business Hour. This guy gets around.
He gets around.
Got his own podcast going on. He's good looking, so I know this is radio, so you have to take my word for it. But in our conversation, we were talking about it. That's an old trader saying, make the trade, manage the risk. And it kind of derives from the fact that, just get it done. Do something, make a trade and then manage a risk, instead of a lot of folks, like business people, will sit there and mull over and over and over. What should I do? What should I do? And never make a decision. Well, make a decision and then manage a risk. Is really what that's saying. But so welcome, Bill Ulivari. Great to have you on the show. Thanks for coming out.
Bill, thanks for having me. This is a super exciting opportunity to chat with you. I'm really glad we have an opportunity to meet and do this.
Well, I thank you for following the script, making sure it's so exciting and fun to be on this show. That's awesome. But tell us, what are you doing now that you and I had to talk yesterday? But
what am I doing now? Well, I love everything that's related to finance and financial services. So, of course, we're managing IRAs and 401ks and small business pension plans. We have a dividend check per month strategy. We're heavily down we've been orange pilled on the Bitcoin and blockchain technology space. So we're including Bitcoin in our client portfolios.
Awesome.
We've got a podcast channel dedicated to blockchain, although lately I've been doing more interviews with old traders from the CBOE, because my perspective is that this new wave of technology that blockchain is bringing to us is called decentralized finance or decentralized lending. And its roots trace back to really the Chicago Board Options Exchange, in my opinion. So when the advent of the Black-Scholes option pricing model came to be, that's when, derivatives really, in my opinion, were kind of born, right? And standardized options born here in Chicago. So the idea of the concept of make the trade, manage the risk was something I used to tell new traders that were just frozen, like paralysis by analysis. Their throat was they were being choked by not being able to shout out and make their first trade. I'm like, guy, just do one. Just do one. Make the trade and manage the risk. So that's where that came from.
Just don't put yourself in that paralysis mode. But yeah, and it's interesting because the options exchange was actually derived from a closet room from the Chicago Board of Trade.
Yep.
I used to work for one of the founders, Dave Goldberg.
An amazing man. Everybody has wonderful things to say about Dave and how he helped really teach classes, tutorials, like whatever you needed. Dave was there for you. He was an incredibly instrumental man. And
both in and outside. He was an incredible family man that lived up near where you're at in that Glenview area. And it was a true privilege and pleasure to work under his tutelage. But so, when we talk about, so the show is Innovative Strategy. So I love having you on because you're doing that kind of a thing. You're looking at all aspects of investment. I told you how I like to look at, a lot of folks just sit there and they're still in that old school method of thinking of investing. Just put my money in mutual funds and let it grow. But we're in a new world, right? Where technology has changed a lot of things. It has changed direction of a lot of companies and a lot of different types of investments. We got ETFs now.
Yeah.
Didn't have those too long ago. Do you get involved in ETFs at all?
That's really all we do, Bill. When we opened up the firm in 2004, because I was a market maker at the options exchange, and when I moved off the floor, we were actually, the company I worked for at the time was quoting options in what was called Merrill Lynch holders. And those were options that were sponsored by Merrill Lynch. And so I've always been a huge fan of exchange traded funds over mutual funds because you could trade them intraday. You have options are frequently listed alongside with the ETFs that can give you an opportunity to manage risk and to enhance your yield. ETFs are tax efficient because they don't have the regulatory or legal structure that's behind them.
Right.
There's just so many benefits to exchange traded funds. And so we've been using, that's really, I would say we exclusively use exchange traded funds in our business.
Yeah, that's interesting because what I really love about ETFs, exchange traded funds, are the difference between them and mutual funds are you can get in and out during the day, like any other trade, like buying a single stock, get in and out anytime you want. Mutual fund, you settle at the end of the day.
Right.
And so you don't have as much control.
And with an ETF, theoretically, you have 100% transparency because the exchange, the sponsor of the ETF will send out an email every single day to participants telling you exactly the percentage of a company, of each company that's inside the exchange traded fund, along with their cash that they're holding on to. So if you add it all up, 100% every day with 100% certainty what's inside. Mutual funds are part of the, they're part of the 1940 Investment Act, Securities Act, where they don't, I think, theoretically have to post their holdings except once every 90 days. I think that's what they're permitted to do. So mutual funds are way more transparent, way more expensive, and they have a different tax efficiency.
Right. Absolutely. But what are some other tactics that you like to use that we might call more innovative nowadays than a mindset that might be from the past?
Sure. Well, I think, the days of the 60-40 portfolio where it's 60% stocks and 40% bonds, I think those days are coming to an end. For us, what we do is first of all, every client takes a survey to determine how much risk and reward they're willing to assume. Because when it all boils down to it, Bill, I feel that investing is an emotional behavior. So you have to be able to withstand all these ebbs and flows and pumps and dumps and bubbles and bursts and still not really get shaken up and rattled by that because, again, we're in for the long haul. And so what we've done is we make sure that we don't go too far out in risk. Clients want to make money on the way up, but they don't want to lose money on the way down. And that's just an impossible proposition on Wall Street. There are no free lunches whatsoever. So everything comes with like a risk reward benefit.
Right.
So we want to nail that. And then also what we do is we really watch what's called the value growth spread, I guess you could say. So there are times where companies that are dividend paying companies, value companies, real estate investment trusts, gas utilities, electric utilities, anything that pays a dividend, consumer staples.
Yep.
We compare that with the growth side, the technology and social media and things that don't pay a dividend. And there's this really interesting relationship, this dance that goes on between growth and value. And when they get too wide, when there's this huge dispersion, we put on our trading mentality hat and say, well, I'm going to sell the overvalued one and buy the undervalued asset class because I believe with 100% certainty, and I just need maybe more time, but they
Yeah.
will converge and go back to the middle like a pendulum of a clock. And so we've really, really leaned into that a lot in the last 3-4 years.
We call that arbitrage.
Yeah, in a way it is. Sure. Absolutely. We're
Yeah,
just,
I used to be involved in that where we did baskets of stocks versus the S&P 500 futures. You know, we would
exactly.
sell a you know the 500 stocks, and we would sell them and then buy the futures against it and collect the difference between the two when they get out of alignment.
It's the exact same idea, Bill. Like you said, you have this fair value of a portfolio. We rank all the exchange traded funds on a scale of 0 to 7. And right now value is like a 4, 4.5, and growth is 0.8,
Yeah.
maybe 1.0. So we feel that there's an opportunity here to sell some of our value positions, which is part of this inflation concept, and then buy growth, which is what you're saying now, like Netflix getting creamed and Facebook and Twitter, these companies just getting slaughtered.
Well, yeah, Netflix lost 200,000 subscribers for the first time,
right?
Ever, that they've gone negative on subscribers. That just came out, but here's an interesting thing that's going on about that. So now towns are switching their cable tax bill that they're putting upon folks that get cable. They've switched that over now to streaming. So if you get Netflix, you're going to pay 5% tax on whatever you pay Netflix. This is going on. I think Chicago has this tax.
Yeah.
It's already done it.
I forgot about that.
But the suburbs are starting to do it. It's going on around the country, and it tells you how quickly cable is losing its grip. And and again, there's when you pay attention to these things, these are investment opportunities, right? Or divestment opportunities if
Right.
you're involved in those. But I like the style. I like the thinking that of the growth stocks versus the tech stocks. That's part of what I like to look at. But I also like to look at things like vertical farming and AI, artificial intelligence, robotics, um, things of those natures.
Yeah, it is very interesting. I mean, I haven't really wrapped my head around that so much in terms of vertical farming. All very interesting, and it's all technology that I love. I mean, I'm like a ham radio geek.
Yeah.
Always loved technology. I wanted to be a TV tube repairman in the 70s. I mean, that's what I went to school for, to be able to repair vacuum tubes. I mean, like, go figure. And now I'm involved in blockchain and Bitcoin and cryptocurrencies, and
Yeah.
got a Spotify podcast for that. So you just never really know where things are going to take you. And there's so many opportunities, Bill. And that's what I find also most exciting. And again, being the owner of my own firm, I don't have this voice talking down to me about what I can say with my clients. I mean, I always run my conversation through the eyes of a compliance officer, but I have a tremendous amount of freedom to be able to pick and choose strategies that I think are best for my clients, and they appreciate that.
It comes with experience and knowledge, and you've been involved in compliance world for a long time.
Mhm.
So it comes naturally for you, where others might have to pay a little bit more strict attention to that.
Of course, we have Bill Ulivari here, right, today, which is great. And Bill, for all the listeners out there, if they have questions about what you do, want to learn more about what you do, how do they find you?
Well, they can call our office at 847-686-4800. Leave a message. Goes to a receptionist. Otherwise, you can visit the website at senecalcapital.com. That's CENACLE, senecalcapital.com. And there's a form handler on the website for people that want to contact us. Please include an email address or a phone number so that we can have a quick conversation. And again, we're trying to meet our clients with the type of strategies that they're asking for. And, we bundle everything together, right? So whether you're a blockchain and a dividend person, cool. If you work for an employer and you need help with your 401k and you have a self-directed IRA and you're into Bitcoin, blockchain, or maybe you're not, that's okay. Like, we can have all those conversations. So if it's traded on an exchange, we can have a conversation about it.
Yep. So a listener asks, says, you mentioned that investing is an emotional behavior. How do you manage or help eliminate that anxiety for your clients?
Great question.
That is a good question. Well, I would say that, again, we make sure that we do a risk survey for them, which ranks their emotional strength, their emotional IQ on a scale of 0 to, say, 99. And in almost every case, people come in either too aggressive or too conservative for their retirement goals. So first, the survey, well, it's not perfect, and it's only a 5-minute survey. It does drive the conversation every time we have a conversation with our clients. So if they call me up and they say, hey, Bill, the market's up, market's doing great, we're up huge, but my account's barely moving, I'll say, well, let's take a look at your risk number. You're conservatively invested, which is why you're not participating to the upside as much as you want to. So maybe we can dial things up a little bit. Or if your account is going down too fast, we'd say, well, why don't we take a little bit of risk off and we'll tune it down a little bit. So that's one thing. Secondly, if you show a long-term chart of the S&P 500, and Bill, I think you'll say this, you'll second this thing. We had the 1987 stock market crash, 89 mini crash, the recession in the first Gulf War, 1994 Russian currency crisis, Asian currency crisis, long-term capital management in 1998, internet.com bubble and burst in 2000 to 2001-ish, the Great Recession in 08 to 09, and then the COVID. So, I mean, again, we're very careful on how we are aggressive in the way we manage assets and the way we are defensive in the way we manage assets, and it's very contrarian. And so that also helps our clients know that when things are getting too frothy, we're selling a little bit, and when things are too bearish and doom and gloom, we buy. We're buying that. So we're always like selling kind of rich, and we're buying strong. So I would say that. And also the clients feel comfortable because I converse with them in a way that nobody else really does. Again, I have to go through the eyes and ears of a compliance director, but I tell it like it is, and I own it when I'm wrong, and I try not to elevate myself too much when I'm right. But I just think that most clients and most customers are misserved by financial news media because they get in at the wrong times and the wrong things. And
the media is crushing us, and you're so right. The emotional side is very important. I remember when computers took over trading pretty much in 05, 06. I was very much a part of that, as much as I was a much part of the 87 and 89 little market corrections. I was involved in that as well. But when the traders started coming out of the pits, they started offering and advertising, hey, try my trading strategy. This works. And try mine. This works. And just follow this method. And they do work, with one exception: human intervention.
Right.
Because we always think we can just tweak it a little bit and we can get a little bit more out of
optimize.
it,
We
and that's when
optimize.
things fall apart. And you're like, what the hell happened? That guy doesn't know what he's talking about.
Right.
No, he was right. You felt you could do better. But you're absolutely right. People have different levels of risk that they're willing to take. I don't like the 60-40 rule. I don't like target dated 401k options. I think it's okay if you just don't know what to do. But if you don't know what to do, that's a great sign to go out and talk to somebody like Bill, or even myself.
Right. No, I appreciate that. So, if you talk to 100 different investment advisors, Bill, you're going to get probably 100 different answers, 100 different ways of skinning the cat. I'm not saying I have this monopoly on the way I trade or I manage my client accounts. I'm just saying this is the way I do it. And this came from, the school of hard knocks, being in the trading pit. Everything I learned from 1982 when I first came down to the trading floor, standing elbow to elbow, getting stabbed with pencils, spit on, pushed around, losing my voice, standing 6 hours a day. Like,
yeah,
we paid our dues being down there, and I bring those skills to my business. And again, they don't resonate with everybody, but I am who I am.
Interesting part about being on the trading floor is nobody there was they weren't rooting for you or against you, but there was no training. It was sink or swim, survive or die. We don't care.
Yeah.
If you're here the next day, we'll say hi. If you're not, we'll say, well, where'd Bill go? Never mind.
Nobody's going to pass the hat around.
No. It's a very interesting world where you might be fighting, kicking, punching, screaming, spitting at the guy next to you all day long, and that bell rings at the end of the day, and you say, hey, where do you want to go golf?
Right.
Or let's go get the wives and go out to dinner tonight.
And
then you go back at it again the next day.
Absolutely. That we were competitors and we were collaborators together all at the same time. It was kind of like being at a food court at a shopping mall, where on one hand you want everybody to come to your station, but at the same time you had to, kind of get along and be civil with each other, but knowing that if you get more than that trade than I do, my kid's going to suffer. So it's kind of passive aggressive, I guess, in a way.
So April is Financial Literacy Month. Do you have a lot of people knocking on both of your doors saying, teach me?
Well, personally, I have more than I have in the last 2 years, for sure.
Really?
Yeah, I think people are finally coming out of the shell. I think the problem with the issue we've had with the pandemic is people had so much misinformation and bad information, and incorrect stuff,
Mhm.
that they didn't know how to make a decision, so they just stuck their head in the sand and said, "I'm not going to do anything."
Mm-hmm.
And now I think they're finally saying, "Okay, we're done with this. Let's move on." The problem we're going to run into here, and Bill, you brought this up. You named the dates over the decades and the years of all the issues that have come up in the markets at the different times, and yet here we are in a 12-year bull run, and there's a lot of people out there who've never known anything other than this bull run,
Right.
and that's a very dangerous situation, I think,
Right.
for those folks, because they may be more aggressive than they should be or need to be. Um, I've had some folks back off and say, let's just reduce our risk out there in the market, because you've had a great run. Let's kind of reduce the risk and see, because there's a lot of concern about the direction the market's going to take going forward. And I just say, even if the market continues to rise, you've had 12 years of straight up.
Yeah.
What's wrong with sitting on the sidelines for a little bit and seeing how this goes?
Right. And I would say, looking back historically at our business, we were generally contacted by the greatest number of people after a big down move.
Yep.
So in 08, 09, people said, oh my gosh, I wrote it all the way down. I sold at the bottom and I was going to get back in, but I was too afraid. And they were in during COVID-19 and into 2020. And they sold their portfolios because they thought that it was going to be a global lockdown. The pandemic was going to, have this effect on everyone. And we never bought more exchange traded funds for our clients than we did in March and April of 2020. And again, this is this paradox. This is the contradiction in investing, is that when things are looking really good, people think that's like they can't get any better, right? I mean, it's this pendulum that swings back and forth.
Let it ride.
When things look so bad, like they did again in 08, 09, and especially in 2020, that's when my screens, my analytics are just strobing, flashing, like, okay, there is a contradiction here between what I see going on and what's really happening in the market. And so then that just gives me comfort, because I trust my wingman, right? Like the movie Top Gun, got to trust your wingman. And
yeah. Well, let me ask you something then. How are those signals playing for you now?
Well, right now we are still in a positive trend. We are seeing a little bit of a pullback, as you said, this rally that we've seen, not just in the last 12 years, but also from the COVID lows. I mean, the NASDAQ was up maybe 120%, 140%. Value, S&P all up huge. So we're seeing a little bit of exhaling, but I'm also seeing an interesting paradox here, where the commodity side of the business and the inflation side of the component world is a little bit overdone, usually higher than usual, and yet growth is getting taken out to the woodshed for a beating. So again, I find these paradoxes very, very interesting, and things that I like to. I'm still in the market, but I'm trying to buy that thing that's overvalued. So again, most of my clients haven't been with, hey, teach me about IRAs and 401ks. They're saying, I can't do this anymore. Help me.
Yeah, I get that. I had a picture pop up, 2-year-old picture. It was a picture of a gas station from April of 2020.
I saw that.
$1.29 a gallon. And here we have the wonderful folks that take care of the CPI number at the federal government here, saying that we have inflation of only 8 point whatever percent. And yet I'm paying over $5 for premium gas right now.
Mm-hmm.
$1.29 over $5. We're only up 8%. It's kind of hard to buy into that. So, for me, I think we have hyperinflation going on, and we're just not admitting it. And hyperinflation isn't just rising prices. It's look at the shelves at the store.
Right.
Mm-hmm.
Like I said, I have a cold. I went to the store to get cold medicine.
None.
And there was about a quarter of the shelf was what was left to choose from. And I won't get into that story about Googling which one do I choose.
Right.
So we have that, and then we have the Fed, who has switched gears. If you remember, Bill, we had this amazing gentleman running the Federal Reserve for a while there, named Alan Greenspan, whom we learned green speak, right? Learned to read
Mhm.
between the lines of what he was saying. But they were front running inflation. They were front running what they saw was a problem.
Mhm.
Now we have a Federal Reserve that is they're chasing it, right? They're grabbing the lion by the tail, is the way I look at it, and it's not as effective, or hasn't proven to be just yet, I should say.
Mhm.
Um, and to have them come out and say, okay, we did a quarter point, but we're going to do this 6 more times this year. Um, Again, a unique kind of play by the Federal Reserve that is most people are unaccustomed to.
Sure. Yeah, I would say that we are at a crossroads, Bill. I don't like to use the word hyperinflation because for me, in my mind, hyperinflation also means a declining US dollar. And we see inflation in everything. And if you look at the US dollar, we're almost at 4, 5, 6 year highs. So again, here's this paradox, this contradiction. We have lumber's off 25 or 27% year to date. We're beginning to see what I think are lower highs in crude oil, corn, wheat, soybeans, oats, all the commodity complex.
Yep.
So I just want to stay open to the conversation of gold hasn't performed. If we were in hyperinflationary
Right.
environment, wouldn't we see gold at 2, 3, 4, 5,000? No, we don't see that. Silver, shouldn't it be over 50, 60,
There's
70?
been no flight to gold or silver, but wouldn't that be partially because of people flying to the cryptocurrencies?
It's possible. It's possible. But again, I'm trying to stay open to everything. I don't want to
Yeah.
I don't want this cognitive dissonance, I think the term is, where I have this opinion and then I just seek out data that confirms that.
That confirms it. Yeah.
So for me, I see some really interesting things. I see the, Japanese yen getting crushed, the euro dollar getting crushed, a lot of currencies getting crushed. I see the US dollar near all-time high. I see, and usually when a dollar sells off, commodities go up. But here we had an interesting paradox again, where the US dollar rallied and commodities rallied. So why did that happen? Could it really be supply chain? Could it really be that inflation is transitory? My opinions of the Federal Reserve are not all that different than yours, but I want to be open to the fact that maybe they're lagging this. Maybe they need this because the pandemic shutdown was so bad, and they're trying to offset these two.
Yeah.
They're trying to internalize the order flow of inflation, supply chain with recession, pandemic. So, I don't know. All I'm saying is that I need a little bit more time to really be able to pull the trigger because I'm seeing some conflicting evidence here. And
to be fair, when you say you don't know, I appreciate you saying that, because none of us know.
Mhm.
We don't have that crystal ball, but there are signs all over the place, and we're accustomed to, historically, when we were trading, uh, signs were more clear if you were accustomed to seeing them and reading them on a daily basis, and
Mhm.
the signs were typically more clear. That's kind of gone out the window as
Yeah.
far as, everything has to be in alignment for it to turn to a bear market or turn into a bull market again. Um, those signs have changed, and things are moving. And of course, when you talk about the yen being crushed and whatnot, I mean, in all honesty, there's no place to go but the U.S. dollar. That most currencies are not doing well, if not all are not doing well outside of the U.S. one. And it's kind of like, U.S. bonds. People used to fly to U.S. bonds. Well, right now, bonds are not keeping up with inflation, right? That's just not a very good investment. CDs, money markets, bonds. Um, they got a long way to go to catch up to what's
Right.
So
going
the
on.
$5 I spent on 1,000,000 rubles wasn't.
No, hang on to that. It might be.
You hold on to that. That'll be right there with your
That's a lottery ticket,
dollar
man.
that you're holding
There you
on
go.
to.
There you go. Hey, you're listening to 216 Net. This is Innovative Strategies with Bill Hasse. Today, we've got our good friend Bill Ulivari from Cynical Capital. Check him on his website out at Cynical. That's CENACLE Capital.com. And he does a podcast, and we want to throw that out there to everybody as well. And I believe it is the Blockchain Advisor. Is that
Yep.
correct?
That's correct. It's
So if you want to know more about blockchain and all that good stuff and the crypto currencies
You better.
yeah,
You better learn that.
it's a great podcast. You can find out on Spotify, or you can just Google, of course, Blockchain Advisor. But you can listen to what Bill has to say on all that as well. So I do have a question for both of you as we're rolling, and I'm going to pull this up here. Um, uh, on the Cynical
Look at that candlestick
Capital,
chart.
yep, Cynical Capital website, you've got why we exist. Cynical Capital Management exists to protect company owners and individual employees from biased opinions and hidden agendas of commission-based stockbrokers and wealth managers. I hear that a lot on radio ads and whatnot. Commission-based. Can you help our listeners who aren't sure what a commission-based stockbroker wealth manager is, guys? Because we would think, us normal beings with artificial intelligence would think, well, you guys get paid on commission. What do you mean commission-based? So if you could help our listeners out with that, would be great.
Sure. Bill, you go first.
No, that's on your website. You
Okay.
got to explain yourself now.
All right, so this is my perspective. When I was on the trading floor, standing in the S&P 100 or OEX pit from 1982 until 2000, every day, the big firms were trying to take advantage of me in a big way, right? Every day, it was self-defense against the big box shops who were trying to hurt me financially and my family and the other 500 guys that were in the trading pit, doing some things that were incredibly unethical. And I swore that I said, when I get out of this business, I'm going to do the right thing, right? So I got our accredited investment fiduciary analyst designation. But what that means, the why we exist, is I never wanted to have a business where I was compensated for selling a good or a product or being enriched at the expense of my clients. I don't want somebody else's research analysis. I don't charge a brokerage fee when I execute. All our services are bundled, right? So we charge somewhere between 0.75 and 1% annually for independent advice. I call it like I see it. And if I make a recommendation, it's because I think it's awesome, right? It doesn't mean doesn't mean it's going to be profitable. You have to make the trade and manage the risk, right? Yeah. But I do it because I think it's in the best interest of my clients on asset management. Now, I will say, as a caveat, I did get my insurance license in the last couple of years. I've sold a few long-term care policies, so that is a commission-based compensation. So I want my clients to know that, right? And we disclose that. But in terms of the way we manage assets, nobody has my ear except me and my client, and that's the way I wanted to run a business.
Well, I do insurance products. I do long-term care. We'll have to talk about that. I am a certified long-term care specialist. So I do that, whole life insurance and other forms of insurance and annuities and things. And those are commission-based.
Yeah.
But, folks should understand that even like buying an annuity, if you put $500,000 into annuity, $500,000 goes towards working for you.
Mm-hmm.
The commission that comes to me is from the company that
right.
you buy the annuity from. They make their money back in a different way.
Yes.
We don't want to go down that.
I didn't appreciate that at the time, though, Bill. But yes, I mean, I definitely see the beauty of annuities and long-term care. But again, my perspective is this: I didn't sell long-term care or offer that because I thought it was a good commission schedule for me.
Oh, right.
It was because if you go to the Federal Reserve website and you look at how far the Wilshire 5000 is trading above gross domestic product, like how far is the market over intrinsic value? We're like 276% above fair market value. So that means that if your house is worth 100,000, on a block, and one down the house is trading, 300,000, and it's the exact same house, which one would you buy? Right. So the market so that was for me my way of, hey, let's use the bubble as an opportunity to lock in our long-term care obligations and our chronic care illness by selling some positions in the market and using it for what we know we're going to need, rather than some of the uncertainty of this bubble that we're talking about, right?
Right. Well, let's look back. Let's look back a little bit. Back in the 80s and the 90s, PE ratios, price to earnings ratios, anything above 20 was kind of considered kind of a high risk scenario. And now we have PE ratios that are in the hundreds, if not higher. Look at Tesla. I don't even know what Tesla's at, but I'm going to guess at 1,000. I don't know, but you know, that used to be the basis of or part of the basis of choosing certain stocks to invest in when you were doing individual stocks and portfolios.
Mhm.
All of that has changed. I mean, a lot of the criteria that was used back in those days is really out the window. Even looking at the numbers when you were in interest rate futures as I was at Eurodollars, and we used to always say, Unemployment Friday was the one day a month you could never ever miss work. There's only two reasons you could miss that day: you died,
Right.
or your wife gave birth to your first child, not the second, third, or fourth, just the first child. Those are the only two reasons you can miss. Both my kids were born on Unemployment Friday, by the way. But so the whole mindset has changed. However, the mindset has changed for folks like you and I, who continue to be in these arenas and follow these things. But for a lot of investors, um, their mindset has not changed at all.
Right.
They still think low risk is I get into bonds.
Right.
Or
And that's, again, Bill, like you said, this is a great paradox. And that is, and what I think has changed that is index-based investing. It's that I'll call it the Vanguard model, for lack of a better word. I don't mean to pick on them, because there's a lot of people have done really well with Vanguard over the years. You cannot beat their fee schedule. But, being an index investor means there's no adult supervision. There's no one there to tell you, hey, you should be looking at this side of the economy. You should be looking at consumer staples or software or internet, and not because you don't care about PE ratios. You don't care about valuations when you're an index investor. You're just trying to beat the S&P 500. So you just mindlessly throw this money into the market, and it works. I mean, let's be honest. Last 30 or 40 years, if all we ever did was only be an index investor, we would miss out on some things, and we would have done, good in others. But
pretty well.
But still, I that's not my forte. Like I like to lean certain ways that I think are really good opportunities, and you don't typically get that from a relationship with a low cost index provider. It has its place. I'm not saying it's just whether it's Chevy versus Ford, passive versus active investing. It's always this contradiction between, theories, and they all kind of work. All right. I'm not going to say that, but
in some way they do. Yeah.
Mhm.
No, I agree with you. It's like, investing in sectors, so people, I always laugh at that, folks. We put you into mutual funds because you're diversified, which protects you. What, you're still 100% in the market. You might be invested in one of the 11 or many of the 11 different sectors in the market, but that doesn't reduce your risk per se. Although you and I both know that certain sectors of the market will get hit on certain days more than others.
Mhm.
But overall, and so we also talk about the percentages, right? So the market's up 18% this year, meaning the S&P's up 18%, or the Dow Jones, which are two different things to look at. But when you put dollars to it, there's a big difference.
Right.
So there's a firm out there that used to and may still train their brokers to say, hey, from 1970 through 1999, if, the market went up. You add up each year of the 30 years and you divide by 30, and the average increase was 14.84%. But the reality is if you put $1 million in 1970 and took it out after the 30 years, the average rate of return was really only 5.24%.
Interesting.
So there's a difference between talking about rates and talking about real dollars.
Sure. And again, I think, so I have to earn my fee, Bill. I have to earn my fee. And how do I do that? Well, if you look at the S&P 500 or the Dow Jones Industrial 30, you say this is the market. Okay, the market was up X percent. The market was down today.
Yeah.
Well, what exactly does that mean? Because if you take one more step of detail, you take a step back. There's the value side of the market and the growth side of the market. Growth is down 17% this year, and value is up 5%. Okay, so there's that paradox. And then let's take another step back. We have building homes, like home builders, semiconductors, textiles, auto manufacturers. I'm looking at my screen right now. Restaurants, gaming, like those are all on the negative side of that pendulum I was telling you about, like a pendulum clock, right?
Right.
Then the far right side is oil, gas, utilities, insurance, banking, transportation index, believe it or not. So inside the S&P 500 are 40 sectors. Well, how do I add value? Well, I do it by leaning into the sectors that are good, or maybe if it gets too extreme, like oil and oil services today, I'll sell a little bit of that and I'll buy the stuff that's kind of out of favor, right? The stuff that's been taken to the woodshed. So when you are an index investor, you get all 40 sectors, good or bad, positive or negative, all in one soup. But again, what we're trying to bring to our clients is, hey, Bitcoin's considered technology, and technology is growth, and growth is the hated child of investing right now. So maybe we should sell some value and buy some growth, and growth means, Twitter and Bitcoin.
So here's the real true value of working with somebody like yourself or myself, who's been in this industry for, I'm done 37 plus years, and I know you're a little bit ahead of that. You started before me. But the real value, because here's somebody like you we're watching it every day, right? So we have kind of a rhythm going. We have an insight. We have a feel. We have that instinct. We see and can make calculations, can make judgments, can make calls, and make trades. If you aren't doing that, you need to be working with somebody who is. Mm. And I'm not trying to knock the folks that are coming in the business as financial advisors that are new and learning and whatnot. It takes time, and we need plenty of those folks to continue. But very hard. It's what makes it very hard to get into this industry and survive that first 5 years, because you don't know a whole lot. And in our industry, they tell you go talk to your family and friends and bring them in. We'll take care of it.
It doesn't have to be either or. It can be both and. You can have your portfolio of index investing and you've got your stuff, fine. But then sometimes you want to talk to an advisor and pick their brain. And sometimes you have your own idea and you pick up the phone and you call your guy and it's like, we don't do that. We're managed. This is the allocation, and the allocation is going to stay because this is just what we do. I don't buy and sell things like that. And he calls himself an investment advisor. I'm like, okay. We'd love to have those conversations. Come on over by us. You want to talk about anything, Conversations Without Borders. We'll talk about it. Yeah. And people like that. So, and again, not for everybody. It doesn't have to be either or. It can be both and.
No, I agree with you. And you should go out and have these conversations. I mean, trust me, we know the majority of the folks out there just don't understand financial literacy, right? They don't understand how money works.
No, we do. We get all of our information on social media.
Well, that's true, and
that's where it's on the internet. It's got to be right.
They couldn't post it if it wasn't true.
That's right. So that's got to be a frustrating part of your guys's your what you guys do to help people and educate people is I think I was reading an article where 75, and this is something different, but it kind of has to lean in. 75% of American adults get their nutrition information or diet information from social media. Nobody ever fact checks. I got to believe financial literacy has got to be up about that same level, 75, 80%, maybe higher, right? So right. How do you?
It's probably higher because a lot of folks go talk to one person.
Yeah.
And they go, oh, that he knows a lot.
Yeah.
And so I'm going to work with him.
He's a mechanic.
But Bill and I have similar mindsets because we have similar backgrounds, but we're still probably, very different in some of our strategies and techniques. But that's a great point. People do not double check or fact check. And we also know that people just don't talk about money.
Right.
It's a very sensitive topic, and most people don't want to talk about money. But again, it's like going to a doctor and telling him what your aches and pains are. Unless you have that conversation, you just never really know. And
I solved that problem by never going to the doctor.
There you go.
Yeah.
Because those aches and pains will go away eventually, won't they? Well, they will.
Eventually they will.
Yes, right.
They will. But, like you said, Bill, you go to the pharmacy and you're just overwhelmed with choices. And again, probably people that come to us and contact us is that they know that they should have financial literacy. They know that am I going to say that they want it? They want it, right?
Yes.
They'd rather go golfing. They'd rather home build, carpentry, home improvement,
vacation,
read books. Like, hey, cool. Like, that's your thing. Awesome. I totally hold space for that. And they want to learn, but honestly, it's a weird person like us that kind of goes down this space because I love it. I love the creative aspect of innovative strategies for my clients, and I posted this a PDF on 33 dividend income funds that pay more than the rate of inflation. I mean, it was by far our biggest inbound marketing tool, report, whatever you will.
Great tool.
And all of a sudden, wow, everybody is now concerned about inflation. And that's really interesting. I talked about the same thing 4 years ago, but people didn't really care about dividends. They didn't care about value investing. And now there's some incredible opportunities. And so
I agree. When folks get concerned, that they think the market may be, let's say, turning a little bit negative or potentially not be as powerful or strong as it's been for the last 12 years, all of a sudden they open their eyes a little bit and start looking at other things. And of course, that's when the media comes into play.
Right.
And takes over and kind of shifts their mindset. But that's why it's even more valuable to talk to somebody like you. And I always love that the analogy we use in the industry is people will plan more for their vacation than they will for their retirement. And the reality is you could plan and save all year long for your vacation, and then you go on vacation. I guarantee you 9.9 out of 10 of you are overspending what you plan to do. Whether you meant to do that or not, it happens. I don't know if I've ever been on a vacation where I said, wow, I spent less than I thought I was gonna. It just doesn't happen.
Right.
Because if I have a little extra money in my pocket, I'll hit the slots on the way out the airport, right?
Yeah, I think we've blown through every single one of our budgets and had a contingency fund that we kept in an envelope in a glove box just in case we a really cool place we wanted to do or a restaurant we wanted to visit. For sure.
And that's when you're planning. So imagine what can happen when you don't plan. Because I call myself a retirement strategist. I kind of focus on that area because that's one area I think people are most weak in is they don't know. They've put money into a 401k their whole life or an IRA their whole life and everything else. They have no idea if it's enough. They have no idea how they're going to get it out or how they're going to use it. They have no idea what to expect in retirement. And it's like, oh, okay, the first 10 years I'm going to travel, so I'll spend most of my money. And then the next 10 years after that, I'm going to be old and I'm probably not going to be doing as much traveling or going out to dinner or anything. So my expenditures are going to go way down. And the reality is that's not true. Then your health problems kick in and the health costs start rising and you wind up still needing that same amount of money.
Speaking of that, if I could just maybe take 3 minutes. This is one thing that we didn't talk about, Bill. Excuse me. And that is, most people contribute to their 401k plan. And when they retire, they're going to have medical expenses. And if you are a small business owner, a small but successful business owner, primarily in like professional services, we don't have enough time to go on a deep dive, but there is a way of creating a pension plan that actually pays for your medical expenses. It reimburses you for your medical expenses and when you retire. So in other words, say for example, you and I are 55 years old. You kick in 10 grand a year into your 401k. I kick in 10 grand a year into what's called a 401h medical expense reimbursement account. It's the IRS clause, 401h for 10 years. And say it grows at 5%. At the end of the 10 years, we will both have $149,000 roughly. All right, $10,000 a year growing at 5%.
Okay.
You have to withdraw $15,385 a year, pay your tax, which is your probably 35% tax bracket, including state and everything.
35, you're giving me a lot of credit.
In order to get 10 grand to pay for your medical expense. I, on the other hand, as a smart and savvy and out of the box thinking business owner, can submit my bill to the trust account and it pays it for me. So I only have to take $10,000 out of my account, and there's no tax on that. It's the only trifecta in IRS history, and that is you can make a tax deduction going into the 401h account. The money grows tax deferred, and it comes out without tax. So here is again ways of creatively and innovatively coming up with ideas to save money. Now, this wasn't even available really until 2006 when the Pension Protection Act was signed into law.
Okay.
But again, way too much for this podcast, but just something to say.
Yeah, we don't want to go too deep into the woods, but
No.
I love that idea. You know, I love that idea. I talked to you about maybe bringing this up and talking about it, but again, the difficult part we have is not going too deep into the weeds. For our listeners and helping them to try to understand just folks that there are some really truly interesting ideas, investment ideas, and innovative strategies that are out there that can help different folks at different times in their lives. And it's why it is so important to be in touch with a good advisor like Bill, and learning what the options are. And that's why you also don't just stick with one person. Talk to a couple of different advisors, because they will have different ideas and they have these different types of plays. There's not much where you can put in tax-free, grow tax-deferred, and get it out tax-free, unless you die. Then there's some options.
Yes.
But that's the only other way that I can think of off the top of my head. And again, we're going to kind of go deep, and you and I can get very technical and analytical and whatnot, but we don't want to go down that road at this time. Maybe we should start building some e-learning classes.
That sounds like a plan.
Start putting some stuff out there and helping folks. But this is getting pretty deep into the weeds, though, in the financial world.
Apologize.
We'll go back to that. Let's go back to the commission side of things.
Mhm.
Also, you're talking about your 0.75 to 1.0 is like a fee of assets under management. And that's really where the market's at these days. I know there are plenty of advisors out there that charge more, and some much more. It's why certain companies can advertise on TV that, well, we only make more money when you make more money. Well, there you go, folks. The first hint is you're paying a percentage of assets under management. So 1% of 100,000 and it grows to 200,000, you still pay 1%. Keep that in mind, because that's also part of the cost of doing business.
Right.
You have to add that into the cost of inflation, any other fees or charges that are involved in there, because that's your break-even point before you actually start getting ahead of the game. And those percentages can add up. With some organizations as opposed to others. There's going to be differences. So that's another aspect that's difficult to think about when you want to go talk to an advisor. A lot of people say, well, what do you charge? Or, how do you get paid?
And you should know. You have got to know.
You better know.
If you have one duty, it's to know what you're being charged. And again, that's why I said it doesn't have to be either and. It could be both. I mean, either or. It could be both and. So again, a portfolio of some maybe index-based, some insurance products to manage the risk in long-term care, Bill, like you had mentioned, and then perhaps some more active management to try to exploit and seek out opportunities that you wouldn't normally see from your mainstream media.
Yeah, absolutely. It's so important to know, because I guarantee you, once you get involved in your investing and stuff, and then you start getting statements, I question anybody. Look on your quarterly statements and tell me what you're paying in fees. I've yet to find anybody who can tell me right where that number is.
Right.
It's so extremely well buried and protected. There's not a one-line statement there that just says, by the way, just so you know, you're paying 1%, asset management fees on an annual basis. You'll never see that again. And so you need to know that, and you need to know how to read your statements, because you need to make sure there are no other fees going on in there, because there could be, if somebody's investing you in mutual funds or managed funds, those are, managed versus unmanaged funds. There's a big difference.
Yeah.
In fees.
And I'm not saying in every single case the fee is wrong. I'm just saying that you've got to know. What I object to is when you go and sit down with an advisor and they share with you all these preferred platform of vendors, and not maybe fully disclosing that they're receiving a small 12B1 fee, like a little kickback, and just make sure that where that's coming from and that's there. I'm not saying it's all evil or anything like that. I'm
Oh,
just saying,
I'm not saying that it's evil either. It's just, is it coming out of your pocket or is it coming out of somebody else's pocket?
exactly.
Do you need to account for that in your percentages of gains and losses? Um, but yeah, no, it's not the evil thing. It's funny because the group I work with, they kind of laugh at me because of all the products that I do work to sell out there. I have no idea what the commission structure is because it really has no bearing
Right.
on
Right.
choosing the choice of what's right for this situation and this person at this time.
Yes.
It just doesn't cross my mind. But there are those out there that have a tendency to try to seek out those high paying commission
Sure.
annuities or insurance policies.
Right. The FINRA website posts settlements and things from both the insurance side and the investment management side, probably on a daily basis. So you got to know, just got to do your due diligence, right? And make sure you know where things are flowing.
Yep. I think I don't know how a car works, right? I get in and it goes, and that's what I wanted to know. I think when it comes to financial literacy, comes to what you guys do, especially over at Cynical Capital, is I've got to be willing to put some gas in, right? If I don't know how to put gas in, my vehicle's not going to go anywhere. So I have to do a little bit of educating myself to understand. But for the intricate workings of that car, that's what you guys are there for.
Well, I have a question for you.
Yeah.
So in that car, the engine light goes on.
Yeah.
How long do you drive it before you actually have that checked out?
Depends what car, right? So if it's the good family car, we get it checked out right away.
If I'm 300 miles from home, I'm just hoping it gets me home, right?
That's right. Right. I mean, so there is that, right? And that's the whole idea, I think, of what you guys do, and especially Bill over at Cynical Capital, is we can watch that in check engine light, but everybody does it. Everybody knows a mechanic, or when we were growing up, you learned how to twist wrenches under the shade tree. Well, the cars now are computer and run by batteries.
I know. It gets software upgrades.
Right. So I don't, I can check my oil still because there's a yellow handle that says oil dipstick. I know where to put in my, the fluid for the washer.
Why did we used to call people dipsticks?
Yeah, right. Well, they measured things. So the idea, I think, is you have to be willing to be humble enough to say, I don't know. And the only financial education I've had is where, do I want plan 1, plan 2, or plan 3 for my 401k? Right.
That's a big choice that very few people know about, right?
Yeah.
When I worked at a bank, major bank, I probably helped 30 plus people choose what they should be investing in on their 401ks, because word got out and nobody had a clue.
Right.
I mean, I'm sure you run into that, Bill.
All the time. I always, they'll send me an Excel spreadsheet. They'll download their positions at their employer, or they'll send me a PDF, and I put them in manually and try to get an idea of what the expenses are, and are they taking enough risk to meet their goals. And most of the time we can reverse math all this, right? This is my age. This is what I'm setting aside. This is where I want to be in the future. This is how many years. And we can kind of get you close to the range of how to meet those goals. So it isn't hard, but it's kind of complicated all at the same time. It's this weird, again, paradox that's in financial services.
Yeah, well, for us, it's not as hard because we know how the numbers move, right? And so that helps. But like, to Ken's point of view, we're not master mechanics, we're not master plumbers, electricians. Yeah. This is what we do, and if this is not what you do, then you should be coming to folks like us to get that insight and to get that help. Mm-hmm. Just as we go to the mechanics and hire the plumbers and the electricians, to come to our homes and take care of things. But or you just go on YouTube and learn how to do it yourself and shock yourself and ruin your plumbing.
Yeah. Next thing you know, you have a hole in the backyard that's filling up with water.
Yeah.
That's a different story for a different show. Anyway, guys, we're right on the back end of this. Of course, we've had Bill Ulivari with us, and he is part of, let me get that up there on the screen. You're going to see Cynical Capital Management. Bill, we've got listeners from all around the globe. We've got listeners. Can anyone reach out to you? Are you licensed specific into a state or territory?
Yeah, well, most of our clients are here in the Midwest, but you can reach out to us, and we have clients all over the U.S. You know, it's not expensive to get registered in a state to do business, and there's also a de minimis rule, which allows me X number of clients before I have to register with the Securities and Exchange Commission. But yeah, we manage assets all over the U.S., and anybody can reach out to us 24/7, 365.
Yeah. And folks, they do a great job. They ask you a quick survey. They assess your risk, make the trade, manage the risk. These guys are great at what they do. We can't thank them enough. Also, check out his podcast. And the name of the podcast, Bill, is
The Blockchain Advisor.
On Spotify or wherever you listen to your podcast, but good stuff, of course.
Yeah, I highly recommend you reaching out to Bill. Unless you're a client of mine already, then you don't need to bother.
Well, you could be saying your
You're
own.
probably well taken care of. But outside of that, no, Bill, I've really appreciated this time and this conversation with you. I have great admiration for you and what you do. Great respect. Just outstanding work. It's great to have the conversations with you.
No, really, we're kindred spirits in a way, and the financial literacy that you're bringing to the table, and it's very, very, very much needed. And that's because guys like us, I tend to talk up too high at a level, right? Because we have these terms and these phrases to express a concept, and we use one word. So to be able to bring it down to a level where everybody can understand is super, super important.
Thanks for your time. Really appreciate it. We're going to talk some more real soon. That's for sure.
Thank you. Thank you, Ken.
You got it. For all of us here at 216 The Net, we can't thank you enough for joining Innovative Strategies with Bill Hasse. Come back at 12:30 for questions you never thought you could ask in church.